All right, welcome IDiF collaborators, old and new faces alike. We are so glad you are here and hope you're having a really good end of the year. So thank you for participating and joining in this discussion. My name is Mona Lisa Como, and I'm the Executive Director here at IDiF. Today's theme is about impact. IDiF's mission at its core is to increase capital to diverse communities. Diversity of capital, either in the hands of diverse leaders, diverse investors, and diverse business owners. Today, we are closing out this year with two leaders making a difference toward a more inclusive system and expanding the American entrepreneurship by diversifying access to capital. I am so thrilled to introduce to you the president of American Entrepreneurship, John Dearie, and Carolyn Rodz, the CEO of Hello Alice. Thank you for joining us. I am going to jump right into it. So Carolyn, we'll start with you. Please tell us a little bit about Hello Alice and also a woman of Latina background, starting your own business. Would love to hear what was the catalyst for creating this?
Sure. Thanks for having me, Mona Lisa. Great to see everybody here today. I'm Carolyn Rodz. I'm the co-founder and CEO of Hello Alice. We are a digital platform for over 1.4 million small business owners across the country, helping to connect them to the capital, connections, and opportunities to help them grow. We believe that with good data, we can make really smart connections for these businesses and ultimately help them build healthier companies that are more sustainable. But a lot of that boils down to making sure they have the capital to inject into their companies. I'll give a little bit of my own background and why I started Hello Alice. And it really boils down to my own story. I am originally from, I grew up mostly in the States, but have family in Bolivia. I had no idea that venture capital is even an opportunity in growing a small business, and started my first company really bootstrapped, without friends and family, without knowledge of what was available to me, and not getting a bank loan or anything, and really struggled with that first company. Ultimately closed it down to start a second business, which I ultimately ended up selling after 7 years. And it was that recognition that the same entrepreneur can have really different experiences based on access to capital, based on knowledge of networks and opportunities. And if we could take that experience and grow and scale that and make sure that every business had knowledge of relevant resources for their company, what a major difference that would make for entrepreneurs across the country.
And so, Carolyn, you've grown to service about 1.4 million entrepreneurs, an achievement you've hit much sooner than expected. I think everyone in the room appreciates kind of how you've done this. You've been also featured in Fast Company as one of the most innovative and fastest growing businesses for women. Anything else in terms of this community that you think would be of interest in the challenges of getting here? And also just the continued forward looking as you continue to grow the institution itself.
Yeah, I mean, where to start? There's so many challenges along the way. A lot of them, frankly, boil down to capital. Elizabeth and I, my co-founder, often laugh when we think about when we first went out to go raise venture capital. The pitch decks that we went in with, we were talking to funds like Sequoia and Andreessen and a lot of the kind of traditional Sandhill Road VCs. And at the time, this was back in 2015, when we first started looking at capital for the company, there was really nothing outside of New York or Silicon Valley. And we had very, very little, well, really no network there and very little knowledge of what the process was like. And so we really learned through trial and error, and I'll say mostly error in those early days. It took us about 1.5 years to raise about 1/3 of the capital that we set out to raise. We realized we were much better at sales than at raising capital. And so we spent a lot of time just growing the company organically, leveraging whatever capital we could. Fast forward to our Series B, where we were actually oversubscribed with one of the leading fintech funds, QED. But a lot of that path has been thanks to a lot of diverse women and minority-owned funds that helped us get there. And helped us bridge that gap until we were ready for more mainstream VCs. And so it's interesting. I mean, I think looking back along the journey, it seems so simple in hindsight. And when I'm explaining to other people how to go raise capital and how to approach this journey, it seems really, really straightforward. But as an entrepreneur going through it, you're looking at, you've never seen a term sheet before. You've never dealt with these legal terms. You've never dealt with the process. It's all very intimidating and very foreign. And that's the process that we focus a lot on trying to break down for what we call the new majority of entrepreneurs, but the fastest growing segments of business owners, primarily women and people of color, but also we focus a lot on people with disabilities, on veteran entrepreneurs, on immigrant entrepreneurs, and the LGBTQ plus community as well.
That's a perfect segue into John and why we wanted this conversation with both of you. So John, exactly, what Carolyn had spoke about in regards to the access to capital, the work that you're doing at the Center for American Entrepreneurship. One, if you could talk a little bit about that, and then also very specifically, you were working on a bipartisan legislation, which, by the way, bipartisan in this town in DC is a huge feat. If you could talk about that and literally how it dovetails into the work that Hello Alice is doing as well.
Well, thank you. And it's a real thrill to be here. And thanks to Mona Lisa and Jenny and for the invitation. And it's really a thrill for me to finally meet Carolyn. I've been an admirer of her work and Hello Alice for a long time. And so it's a great aspect of this event to be able to meet her. The vast majority of my background, my career has been in banking and financial policy. I started my career at the Federal Reserve Bank of New York in bank supervision and foreign exchange, was there for about 10 years, and then joined an organization called the Financial Services Forum, which was a financial and economic policy group comprised of the CEOs of the 20 largest financial institutions in the United States. I was there from 2000 to 2017 as the policy director. I was the acting CEO for the final 2 years that I was there, but the formative experience of my career up to the point that I took the turn into entrepreneurship was the 2008 financial crisis. I had a ringside seat to the crisis, both in terms of the institutions that were failing because it was the members of the forum, and then I got pulled into the policy response by some relationships on Capitol Hill. It was after the financial crisis and as the economy began to grow again, but very slowly, that I began a project to try to come up with some new ideas for policymakers in Washington to accelerate economic growth and job creation as we came out of the financial crisis. Because as those of you who are old enough to recall, the recovery was very slow, both in terms of the pace of economic growth and the pace of job creation. As a matter of fact, 2 years into the recovery, so by the economy began to grow again in the spring of 2009. By the summer of 2011, 2 years into the recovery, unemployment was still north of 9%, which is astonishing to think about as we sit here at 3.5%. So as I began to search for new ideas for policymakers to accelerate the recovery, and following my nose through the research is how I came across a lot of research that was new at the time, indicating the importance of startups and entrepreneurs to innovation, economic growth, job creation, and very intriguingly, work done by the Kauffman Foundation, Bob Lighton, Ian Hathaway, and others, indicating that entrepreneurship in America had been in decline for 4 decades, which was shocking. I didn't believe it, frankly, when I first heard that. I mean, I thought, how in the world can that be? We're the United States of America. We're the most innovative and entrepreneurial country on earth. We have Silicon Valley. We have Shark Tank. How could entrepreneurship be in decline? But I called up Bob Lighton and Ian and others around the country who were doing similar work, and saw the data that they had collected, and in addition to being terribly alarmed by this, was terribly intrigued, because if it were true that startups and entrepreneurs are the real engine of economic growth and job creation, and if entrepreneurship had been in decline for 4 decades, that would explain potentially why the Herculean policy efforts going on in Washington to try to accelerate the recovery out of the Great Recession weren't working, suggesting that policymakers were digging in the wrong place. I became very intrigued to trying to figure out why the decline in entrepreneurship was happening. I and another colleague at the forum decided to get out of Washington, travel the country the summer of 2011, doing roundtables with entrepreneurs all over the United States, asking them very simply, what's in your way? They told us. It was the most fascinating experience of my life. I ended up writing a book about it that was published in 2014. And as I was finishing that book, it occurred to me there's no organization in Washington whose purpose is to engage policymakers, to educate them as to these realities, about the importance of startups and entrepreneurs, that entrepreneurship appeared to be in trouble, why that was happening, and what to do about it. So I decided to leave the forum, start the Center for American Entrepreneurship in 2017. And right from the whole purpose of CAE, CAE is a nonpartisan research, policy, and advocacy organization. Our job is to work with policymakers here in Washington primarily, but also around the country at state and local levels to improve policy circumstances for entrepreneurs. And right from the very beginning, addressing the unique challenges, needs, barriers that confront women founders and entrepreneurs of color has been central to CAE's work, for the very simple reason that if you want to turn around a 4-decade decline in American entrepreneurship, you want much higher rates of participation by women founders and entrepreneurs of color, which is the reason why IDiF's work and Hello Alice's work is so important, and we're collaborators in that regard. So, for example, one of the things that we did immediately after starting CAE was we established the first ever House and Senate entrepreneurship caucuses. The fact that there had never been an entrepreneurship caucus in Congress was vivid evidence of the extent to which entrepreneurship was just not on the radar screen in Washington. We changed that and established the 2 caucuses in 2019. And the very first 2 events that we did with the Senate and House entrepreneurship caucuses were roundtables with women founders. The first event, we flew 22 women founders from around the country into Washington to do a 2-hour discussion with the members of the Senate Entrepreneurship Caucus. And then we did another event, identical, in which we flew in about 20 entrepreneurs of color into Washington to have the same kind of discussion. At the very top of those discussions in terms of challenges and barriers was access to capital. Particularly for there are problems in access to capital in each category of sourcing, either in terms of bank capital, angel capital, venture capital, alternative sources of capital. But we've all heard about the problem, the current, what I regard as an atrocious distribution along gender and racial lines of equity capital in this country. Something like 2% of equity capital goes to women founders, less than 1% goes to entrepreneurs of color. And I had written about this with some frequency, and we spent a lot of time trying to figure out, is there something that public policy can do about that? And your mind immediately goes to things like potentially tax credits or tax incentives, things like that. But about 1.5 years ago, a number of entrepreneurs of color and fund managers of color came to us and said, hey, we've seen that this is on your radar screen. You're writing about it. You're calling attention to it. We know why this is happening, or at least one real reason why it's happening. And they educated us about the limitations on the cap on the size of and the number of permitted investors that can participate in Section 3C1 funds, which is the section of the Investment Company Act of 1940 that most private funds are organized under. And the effect of these parameters or limitations on Section 3C1 funds have the effect of keeping the investor base, those who participate in funds, who invest in entrepreneurs, overwhelmingly white, male, and institutional, with the predictable result that the entrepreneurs who get that capital tend to be white and male. So We took that idea to Capitol Hill and began to work our relationships on the key committees and to jump forward to the exciting news that happened on November 17th, is the Expanding American Entrepreneurship Act, which is co-sponsored and was introduced by Senators Jerry Moran of Kansas, Tim Scott of South Carolina, and Mark Warner of Virginia, the Democrat, who himself is a very successful former entrepreneur. Introduced the Expanding American Entrepreneurship Act, which would raise the size of permitted funds of Section 3C1s and raise the number of permitted investors, with the effect of making it easier for more women investors and investors of color to participate in investment funds, with the hope that will help direct more capital to women founders and entrepreneurs of color, because we know from research that more diverse funds and funds run by fund managers of color are 3 to 4 times as likely to invest in entrepreneurs of color or women. So that gives you a really quick explanation of where CA came from, our focus on the unique needs and barriers facing women and entrepreneurs of color, and the intentions of the Expanding American Entrepreneurship Act.
Thank you, John. And that is so important. So dovetailing again to what Carolyn was talking about, her experience, and I'll pull you both on the screen here so that we can have a little bit more interactive conversation about this. So Carolyn, you had indicated that in your experience, you had found that it was mainly women investors that had leaned in. Yeah, QED, really big investor group as well. But as you were being mentored along the way, that was a huge source of kind of intellectual capital that you were gleaning on how to grow your business. John, you also had mentioned in some of your research that homophily, the term, which you, if I want to reiterate the statistic, you said 3 out of 4 you will invest usually in, so if it's a diverse leader, we'll usually invest in diverse investor groups. I want to make sure I got that data point correct.
They are 3 to 4 times as likely to invest in entrepreneurs of color or women, according to research, a paper that was released last year by Josh Lerner at Harvard.
Okay. And the reason, and Jenny, maybe we could drop this in the chat, this is how we're bringing the entire IDiF circle and community to understand this point. So while we have focused very much so in many convenings about the institutional capital leaders and ensuring that we are putting that in the right hands, what we wanted to bring to this table was then how that trickle down effect happens to businesses, and then also how we have supporting acts and legislation that can continue to foster more diverse investors in the space in general. So a question to both of you, as you are kind of at the forefront of this work. From your perspectives, how will we increase participation in capital markets by a broader group of investors and founders? You are very much, John, working on the policy side. Policy is one, but that doesn't mean it's a clear path, because there are some challenges. And then Carolyn, not only is it just the amplification of the work you do, and then once you do have small businesses, once it's having access to those means, how are you then also continuing to help those business owners and entrepreneurs as well?
Sure. I'm happy to kick off on the founder side. And I think we really look at it as there's 2 sides of the equation, right? We have to bridge the gap and build healthier small businesses that are even eligible for venture capital, for bank loans, for traditional kind of Main Street capital. The reality is over 50% of businesses are financially unhealthy. They may or may not have scalable models. There are credit score risks. There's a whole host of issues that are happening on the founder side. And so we spend a lot of time and energy focusing on that piece of the puzzle. How do we help businesses in their earliest stages? When we look at a Black-owned business versus a white-owned business, that Black-owned business is typically starting with half the capital as a white-owned business. They are only 16% of Black-owned businesses are actually getting access to the capital that they need to grow. And so one is building a stronger foundation for that business in the earliest stages and helping them bootstrap their ways, but also helping to bring in outside capital like grant funding and loans that are willing to take on a higher tolerance of risk for a variety of factors, whether that's through CDFIs or government-backed lending or private sector loans that are looking at alternative data points. And so there's a ton of pieces on that end. Through Hello Alice, we've issued over $40 million in grants. Most of our data shows that only $10,000 of grant funding can actually help change the trajectory for a small business. The other side of the equation is working with the private sector. There is, every corporation out there has a vested interest in the success of small business for a variety of reasons, whether it's community development efforts, diversity and inclusion efforts, marketing efforts, innovation, lots of reasons that they're looking at the small business sector. And so we work a lot with them to say, look, these are the needs that entrepreneurs are facing, particularly when it comes to capital. Here are ways that you can repurpose your programs to help bridge those gaps. A great example, we're working with Wells Fargo right now on an equitable access to capital fund for business owners who don't even have access to a credit card. And so Wells Fargo is utilizing grants to help backstop that risk so that people can get their first credit card, help bridge some working capital, help them get to that stage where they can get a loan, ultimately moving them towards venture capital. And that's just one example of one of the programs that we have going on. And so those two pieces are really big components. And I love, John, the work that you're doing on the policy side, because it's another really critical leg of the stool that without good policy, none of this works. And I think we're seeing in the environment today, a lot of this is under attack, right? In terms of diversity and inclusion and the way the market is going, we're actually seeing a lot of pullback in these spaces, which is quite frightening. And so I think these areas where we're seeing momentum happening is great, because it's a way to figure out how do we build a win for everyone that actually moves us forward. Because at the end of the day, when these companies succeed, we all succeed. It's more money injected into the economy. It's more jobs created. It's more stability in our communities. It's a win for everybody. And so I think all of this work is really critical, but it's not a one-size-fits-all kind of single solution approach.
Right. And John, about, the cap on, the funds, 10 million or less is too small to have a meaningful impact. Your act is actually challenging that. Can you talk about how that can help a lot more in increasing access to capital?
Sure. And I think a numeric example makes the current problem quite easy to understand. So under section, private funds can be organized under either two sections of the Investment Company Act of 1940, either section 3C1 or 3C7. So both funds can be, the act allows, or the two sections allow the funds to be as big as they want, but there are restrictions on the type of investors and the number of investors. So for 3C1 funds, which is the most familiar section, and most angel capital funds, venture capital funds, private equity funds, et cetera, are organized under 3C1. The investors have to be accredited, and the number of investors is limited to 100. For section 3C7 funds, the investors are referred to as qualified purchasers. The requirements are much higher. You can sort of think of them as super duper accredited investors. But ironically, and I'll come back to this in a moment, well, or maybe I'll say it now because it's an interesting policy observation. The number of investors can be 2,000 in a fund. Now, the reason why that's interesting is because, first of all, there's the question, where did these numbers come from? And we don't know. I wasn't there in 1940. But I think if you put yourself in the mind of Congress at the time and, and the newly created SEC at the time, these funds fall outside of the requirements for registration, disclosure, all the regulations, having to do with publicly accessible funds. And so if that's the case, you would want to limit the size of these funds to a relatively small number of people. And they, for whatever reason, came up with 100 for 3C1 funds and 2,000 for 3C7. The irony there is that if you have a fund of similar size, say $100 million fund or whatever it is, $1 billion fund, because you have more permitted investors in the 3C7 funds than in the 3C1 funds, the exposures are smaller because you're cutting the pieces into 2,000 pieces instead of 100. So ironically, the participants in the fund, the super duper sophisticated investors in 3C7 funds have smaller exposures than the 100 investors in a similarly sized 3C1 fund. And that just makes no sense from a policy standpoint. So that's one problem. But going back to 3C1, if you have a relatively small fund, a $30 million fund, which is quite small by industry standards, do the math. You divide 30 million by 100. Every investor who participates in that fund has to write a check for $300,000. That's a lot of money, even for accredited investors. And it's especially what we know from research, it's especially a lot of money and out of the reach of many accredited women investors and especially investors of color. So in order to raise a $30 million fund managers tend to have to go to white male or institutional investors, and it has the predictable result of steering investment into entrepreneurs who look like the investors. That's the phenomenon of homophily, that investors tend to invest in people who look like them, have similar life experiences as they do, and are building companies that they can relate to. So there was a piece of legislation in 2018 that is relevant here. It was actually a Dodd-Frank Act cleanup bill, but it had an aspect to it that recognized this problem and said, and you referred to it a moment ago, if your fund is really small, $10 million or less, you can have 250 investors, this act said. And so the 3C1, Section 3C1 of the Investment Company Act has already been amended to have this subcategory. The problem, that was a step in the right direction in terms of the number of permitted investors, but the problem is the $10 million cap. It's too small of a bat, is the analogy that I use, to swing at the problem of this atrocious distribution of equity capital. Can't solve the problem with $10 million funds. And as practitioners have pointed out to us, you can't run a fund, a $10 million fund, because 2% of $10 million is $200,000. You can't hire staff, you can't do back office. It just doesn't work economically. So the Expanding American Entrepreneurship Act, as I mentioned, would raise that 2018 category cap from 10 million to 50. It's an incremental change, but it's not insignificant. We'd love for it to go higher, but it would raise it to 50 million, and it would double the number of permitted investors from the 250 to 500. So if you go back to that $30 million fund example, if someone is raising a $30 million fund now, if the act passes, instead of having 100 investors, because it's above 10 million, instead of having 100 investors who have to write a check for $300,000, now they can have 500 investors. Do the math. Each investor would have to write a check for 60,000. That's way more in the range of a more diverse group of investors. And we know, by way of homophily and the research that documents it, that who gets funded depends a lot on who is doing the investing. So if you diversify the investor base, there's a lot of confidence that you'll diversify who gets funded. So that's the idea of the act.
Outstanding. And thank you for that explanation. Carolyn, kind of hitting right to, where you see this implemented. You talked about some of the barriers, whether it's credit scoring and kind of structurally. I know Hello Alice does quite a bit in terms of supporting that. You also have access to a lot of data in terms of the challenge. And I wanted to highlight that for some of our community, because I do think that that's helpful for our institutional community. So thematically, as John had indicated, the capital barrier, we know that there are structural issues specifically with the institution, the Accredited Investor Act, or not act, but the Accredited Investor Rule requires investors to have a certain level of financial net worth, which at this current time in the United States and for a while that naturally excludes a number of women as well as underrepresented communities and people of color. And Carolyn, now then transitioning to kind of the work that you guys are doing to help these startups and these investors are two questions. One, where do you see the stages of that need? Is it always in the beginning part of it? And then, you know, in the startup, and then outside of the startups, the businesses that you see that come to you that are in maybe a late stage growth or struggling, is there anything thematically that's showing in terms of systemic structural issues that we also need to tackle in the same way that John is tackling the Investor Act?
Yeah, I mean, it's interesting. I think the area that John is targeting with this is critical, right? Because we sort of see it's almost like this bell curve of funding, right? In the very early stages, there's no funding. When it comes to Main Street capital, the businesses aren't ready. There aren't a lot of tools to help bridge that gap in the very, very earliest stages that I spoke about earlier. We then see some of these early stage funds that popped up, and primarily, you know, we saw a lot of those pop up around we saw a wave of them come with the Me Too movement. We saw another wave come in kind of the early pandemic days, and with the George Floyd murder, a lot of awareness built around these gaps that existed. And so, but they're small funds. They're very small funds. They're very early stage funds. A lot of people were fueling capital from, you know, corporate dollars or institutional funds that were distributing funding to more diverse led funds. But then it drops off, right? Because they're typically quite small funds that are making a handful of seed or early stage, kind of pre-seed, seed stage investments. And what happens is, particularly in a market like today, when things tighten up, and a lot of the companies that have been funded by these giant funds are able to go out and raise insider rounds and bridge these gaps, companies that have raised from these small, diverse-led funds are really left in the lurch, right? Because there is nowhere for them to go. The big funds are deploying capital towards their pre-existing portfolio. These small funds don't have the capital to hang in later stages when it gets to Series B, Series C, and beyond. And there's a real, you know, we see a major gap that exists for companies in those two stages. So I think we've had some great traction and momentum happening in the very earliest stages of venture capital, but there's a lot of work to be done very early stage, kind of prior to that in the readiness programs, and then beyond. I mean, even as early as Series A, there's definitely a drop off that happens.
Oh, we can't hear. Hold on. There might be something.
No, it's me. I was hitting
there we
way
go.
too many mute buttons. So John, kind of going then based off of what Carolyn was saying, you know, the Center of American Entrepreneurship not only focused on early stage and startup, the work that they're doing, seeing on the continuation and furthering of these businesses that have been out there for a while, and are trying to find ways to succeed. Thematically, one is there work that you guys are doing that's kind of helping in this front, and is there anything else for our community that they should be aware of?
Well, there are all kinds. I mean, as Carolyn points out, there are all kinds of needs of entrepreneurs along the continuum of development. And if you, I think the most efficient way for me to answer the question, if you go to our website and you look at our policy agenda, we are focused on the full range of issues. Access to capital is just one of them, and we're only talking about equity capital at the moment. We're focused on improving access to bank capital, improving access to alternative sources of capital, and then we're also focused on tech transfer and commercialization issues, focused on access to talent, workforce development, immigration reform, high-skilled immigration reform, regulatory issues, and tax issues. There's a very, very important tax issue that I'm sure a lot of the folks on the call are familiar with, and that is the change to the tax treatment of research and development investment that came out of the Tax Cuts and Jobs Act of 2017, but diabolically didn't kick in until tax year 2022, which startups are filing for right now. And there was a major shock this year with millions of startups and other businesses around the country suddenly realizing this year that they were going to have a major, even life-threatening tax liability. And we're working hard with a number of other organizations and Senator Todd Young of Indiana and Maggie Hassan of New Hampshire, who have introduced the American Jobs and Innovation Act back in March, bipartisan, about 60 or 65 co-sponsors in the Senate that would fix that problem. So we're active on a whole range of things. Two things I did want to just tack on to what I said previously and to what Carolyn just said. First of all, it's important for everybody to understand that there is a House version of the Expanding American Entrepreneurship Act. That's the Senate bill. The House bill, because it's a House bill, it has to be an acronym, right? It's called the Improving Capital Allocation for Newcomers Act, or ICANN Act. The interesting thing about the House bill is that it would raise that $10 million cap. The Senate bill would just raise the $10 million cap to 50. The House bill would raise that $10 million cap to 150. So a 15x change. You can raise much larger funds, and it would raise the number of permitted investors from 250 instead of to 500, like the Senate Act does. It would raise the number of permitted investors to 2,000 to equalize the number of permitted investors between 3C1 and 3C7 funds, as I described at the beginning. That is incredibly significant were that to pass, because, for example, you could raise an $80 million fund, a sizable fund, or call it a $100 million fund with 2,000 investors. Everybody has to write a check for 50,000. That would be, I mean, what we have heard from entrepreneurs of color, fund managers of color that we have worked with. This would, quote, their words, not mine, change the world for them. So this is why this is such an important priority. This is very exciting, but there are also things. Carolyn just very kindly said that policy matters. It's also important to head off bad policy. And I'm going to alert everybody, there are a lot of folks on the call are probably familiar with this. The SEC right now is giving serious consideration to, quote, updating the criteria for accredited investor. In other words, the net worth and annual income requirements to be defined as accredited investor to meet that accreditation standard to be able to invest in funds that invest in these entrepreneurs. Those standards have been in place since 1982. And there has been a movement underway for years for those standards to be updated to account for inflation. If those standards were updated to account for inflation, they would be tripled. And according to the Angel Capital Association, if that happens, the number of accredited angel investors in this country could decline by 2/3 because people would be priced out of being accredited investors. So this is actively being considered right now by the SEC that would completely blow away the progress achieved by way of the Expanding American Entrepreneurship Act and the ICANN Act. So we need to be this is why policy matters. We need to be very vigilant to make sure that these two acts pass and that tripling of standards for accredited investor doesn't happen. Anybody who is interested in participating in that work, that's the work that we do. We work with policymakers. Anybody who is interested in helping or being involved in that should email me, and we welcome the help.
That's exactly where. And so we are at time because we know that there are questions. Carolyn and John, thank you. We want to open it up to the community. But before we do that, part of our goal is to amplify the work that leaders in the industry is doing. Carolyn, Hello Alice, also a growing company. Would love to, is there any ask from you for the community, whether it's, continuing to support the business and forwarding, opportunities that they can open up to your customers, or just how we can help you grow as well?
Yeah, thanks, Mona Lisa. I mean, I'll say anything that anyone is doing to tap into the small business space. We really serve as a channel into millions of small business owners, whether it's corporations that you all have ties to that are running programs. Would love to discuss ways that those might be better optimized, or ways that they can be amplified to tap and support more small businesses, whether it's grant funding, innovation programs, supplier diversity efforts, whatever they may be. The other side is for those looking to deploy capital towards startups. We are a great channel to find diverse and unique small businesses that may not necessarily meet the mold of traditional venture funding, but are really, really great opportunities. So anything that anyone's doing, reach out with respect to small businesses. Happy to discuss ways to help build up those programs and tap into the small business community. And then I'll also just mention quickly, we are actually, as part of our efforts to deploy capital, have a lawsuit that we're facing right now from America First Legal and Stephen Miller. For those interested in learning more about it, we have the whole, all the documentation and our motion that was recently filed at elevatetheamericandream.com. Thanks, Jenny, for sharing the link. But you can go read up about it and learn just ways that you can support. We're not asking for funding or for any of that. It's really more about amplification and then helping to spread the word to drive more small businesses, to really create a really unified voice for small businesses.
Perfect. Thanks, Carolyn. And John, bipartisan, it's an introduction. It isn't law. It hasn't passed. How can we help and amplify the work that CAA is doing?
Well, this is going to be passing these two bills through Congress, as difficult as that is to pass anything these days. But as you made the point at the beginning, the fact that this is bipartisan in the Senate is a big deal, and it's not bipartisan yet in the House. We want it to be. If it's bipartisan, the chances of passage go up. So it'll be a top priority of ours in 2024. We do have an agreement, as I mentioned, with the New Democrats in the House, which is the largest coalition of Democrats in the House, business-friendly, entrepreneurship, innovation-friendly, centrist Democrats who want to hear from entrepreneurs of color and investors of color as to why this act is so important in January. Anybody who is interested in being involved in this aspect of CAA's work or any others, both in terms of activities or support or anything else, visit the website. Feel free to get in touch with me. My email is super simple, John's, John, at startupsusa.org. Very simple. Be delighted to hear from you and to include you if you're interested in being involved in our work.
Wonderful. Okay. So then, Jenny, we will turn it over to you for questions from the audience. And when we do take you off mute, if you could identify yourself so that we can actually get to meet you as well.
Yes, and there is just one person in the room who I do just want to give a shout out to. Allison, can you just come off mute and just say hi? Allison Byers, please just introduce yourself and tell everyone what you're working on, just because it's super relevant to this conversation. And then I would love to hear what the investors, what John and Carolyn have talked through. I'd love to hear, to have a discussion about the higher fund cap and, just given the thoughtfulness in the room. So hi, Allison.
Hey, Jenny. Thanks for inviting me to give a little bit of info on the other work that I'm doing. So this has been a fantastic session, by the way. Thank you for putting it together. Thank you, Carolyn and John. This has been really fascinating to learn about. I'm a startup entrepreneur. I'm a two-time founder who's experienced all the things that we were talking about, or you were all talking about on the call today. And I also got involved in legislative activism. So I just am going to take a really short minute, but to talk about two bills that I've been involved in that are at the state level versus a federal level approach, but they're all collaboratively working toward the same thing and toward the issue of putting some regulations around the field of venture investing, which have not existed before. So in California, I helped author and testified for California Senate Bill 54, which was recently signed into law. It's amazing, and it will require funds to publicly report diversity metrics of their investments. And this is for anything that has a nexus in California. So whether the fund is in California, they will have to report, or if a fund invests in a company that has a nexus in California, they will also have to report. And California is responsible for 36% of venture investments. So this we'll see a global impact here in terms of really foundational data collection that has never happened before to give us more transparency. And then the other bill that I'm involved in is in Massachusetts. This has not passed into law. It's going through committee right now. We're waiting to hear from committee, and then it would move on to the House and the Senate, which is the bigger challenge. But that's a little bit of a different take. It would expand workplace protections against discrimination and harassment to the fundraising process, so that we can have some safeguards for entrepreneurs where it is a career that is not protected as a career. And while the data element is critical, so is understanding the harassment and true discrimination that people go through all of the time, women in particular, because 93% of venture dollars are controlled by men. It puts us in situations that are just ripe for harassment and bias and discrimination. So that effort is very much live, and there's a joint letter of support out there. I can put links in the chat, but we need all the support we can. That so far has been a grassroots effort.
Thank you, Allison. Appreciate you sharing. So we're just going to kick off the Q&A and just have a thoughtful discussion. So I'll just go with everyone. If you want to either pop your question into the chat or raise your hand. And as Mona Lisa said, if you're able to come off camera and introduce yourself, that would be awesome. So I'm looking on the left side of my screen. I see Vanessa.
Hi, everyone. Vanessa Lowe. I am on the investment committee for the Unitarian Universalist Common Endowment Fund, and I'm interested in connecting with other faith-based investors to talk and collaborate and really try to spread the word, as this is, I think, sort of the next step beyond. A lot of us have done CDFI investments, love that industry. They've kind of really reached that a level of stability that they're no longer cutting edge. They're still wonderful to do, and so I'm very interested in getting my fund to invest in some of these specific funds, those that are really addressing, we'll just say, decolonizing wealth, right? So please connect with me if you're interested in talking about that, faith-based investing. The other question I guess I have for the speakers here or anybody is, have we, and I admit I joined late, the conversation around revenue-based financing. So one of the groups that we'll be talking to soon is Founders First, Kim Folsom's group. And I particularly like that model because of the problems with venture capital, right? I mean, it depends on, one company being sort of like the stellar performer and the rest essentially understanding and knowing that they're not going to go anywhere. So did I miss that conversation, or are there any comments from anybody about revenue-based financing as an alternative to the venture capital model?
I'll just share quickly, Beth. It's an area that we are really focused on. We actually have we have a lending marketplace on Hello Alice that has about 92 different lenders, and we try to provide a wide variety. They're all vetted to make sure that they're fair market lenders and not predatory lenders, but we do have some revenue-based financing lenders on there that are, and it's been really well received by the market. And I think, to your point, it's an area that's growing quite a bit for a variety of reasons. It does fit a very specific type of company, so it works really well for certain businesses. It doesn't work so well for others, but for those that it works for, I think it's a really, really great and very affordable capital solution.
Thank you.
John, do you have anything to add on? No?
We're aware of that. We're obviously aware of that model, and agree with Carolyn that it's It's terrific for some, it's not so terrific for others. We're not aware of any particular policy issues associated with it. But undoubtedly there may, or there may well be aspects of that could reach policymakers' attention, or potentially that we should bring those issues to policymakers' attention. So if folks are aware of those types of regulatory or legislative problems with a revenue-based model, let us know, please.
Awesome. Okay, I'm just looking through the chat. I see Edna. Hey, Edna.
Hello. Yeah, sorry. I have to be off camera because I just left a meeting, so in a corner. Thank you so much, and I am so glad that I was able to join later on. I had a quick question around how I can potentially find resources that help me to move forward in my fundraising. So right now, I am working on raising my first VC fund to invest in diverse-led startups. The difficulties in raising itself is there. Again, the first time VC fund, it's tough to actually raise. I get it. So it takes about 12 to 18 months, let's say about 2 years to actually launch the fund. And obviously this is to approach it as a part-time job is very difficult. So you kind of have to mix it up with really going full on or really having supportive systems. If I were raising a startup in itself, I would have gotten small business grants, help here and there, government funding here and there to be able to help me push the fund. However, because it's just a VC fund, it's difficult to actually find any supportive resources to help me raise the fund. And I think that's one of the challenges that, any minority or even someone who does not have that huge network and those resources to raise the funds right out the gate faces. And that's why a lot of us are not in the space. Does anybody have any knowledge on resources that I could potentially tap into as I continue to raise the fund that I'm on now?
And I'll share a couple. I'm happy to connect you with people who have been through this. I think particularly for the first time fund, it is really difficult. I know Bank of America had a huge effort. They were deploying capital towards, and then Melinda Gates Pivotal Ventures as well has a real focus in this space also. I do think I'm not sure what the level of traction that they're looking for, whether there's a certain amount of capital that has to be raised already and committed, or they're matching. I don't know the details. But I would check into both of those, and I'm happy to help you navigate that as well. And then there's a few people, I think the best way is probably to connect with people who have done it and just hear their paths. But I'm happy to share. If you just want to shoot me an email, it's just carolyn@helloalice.com, and I can connect you with a few contacts.
Are there any?
Sorry.
Go ahead, John.
I was just going to say that's a very intriguing question in terms of providing policy help or resources for folks who are raising funds. That's a very interesting question, and I'm going to take that and share that with contacts of ours, both at the relevant agencies and on the Hill. But the thing I wanted to remind you of, Edna, is that I presume that your fund, it's your first fund. I presume it's relatively small. If it's $10 million or less, under the 2018 law, you can have up to 250 investors. So that means that people, LPs in your fund, can be writing checks for as little as $20,000, $30,000. A lot of people on the call probably know Matt Conwell. He has shared with me that that's how he started his first fund, is he took advantage of the 250 investor rule for funds of 10 million or less. So I just wanted to remind you of that you do have 2.5 times the number of investors that you would if it was a larger than $10 million fund.
Got it. Thank you so much.
And before Jenny, you take this, can I just add one more, and then Jenny can. The other thing, Edna, and I think we talked about a little bit about what John was saying about the raising of the Accredited Investor Act. There's actually a number of successful, diverse business owners that probably have never invested in a fund. They probably done it, with their own, because in many communities, these very successful business owners, they actually act as their own little banks where they're helping other business owners get started. But investing in a fund is a different experience. The accredited investor rule as it stands, fortunately, even still, while it's a high bar, there's also value in finding investors that you think are valuable that maybe have never done it again. I have never done it. And then secondly, just being very conscious of the reason why we need to work towards the new legislation that would raise the bar, because I believe it's currently 300,000, John, for the demarcation for the accredited investor. It's a net worth of at least 300,000.
It's an annual income of 200,000 over the last couple of years, or 300,000 for a married couple, or a net worth of $1 million. That's the current criterion. We're at risk of that being tripled, though, so that it would be 600,000 annual income, 3 million net worth. You can see how that would, very negatively impact the availability of startup capital.
And the types of people who would qualify specifically for women and underrepresented groups. That will be a high bar to jump.
Indeed.
All right, Jenny, we probably have time for one more.
Yeah, well, I was just going to ask, because I know that there's lots of fellow emerging managers on the call. If anyone is able to unmute and maybe just leave a word of advice with Edna, that would be awesome. Can anyone take their camera off? Heidi, I see you. Jason, I won't call you out, but I see you too. Heidi, any words of advice for Edna?
Oh my gosh, I wish. I'm a very new entrepreneur. We're about 2.5 years into our business. We're an asset management firm, but it is incredibly challenging. I knew that going in, but it's been 10x that. And I think the biggest issue is there's things you can control and things you can't control. And I think objectively, the things that we control, we've executed about as well as we possibly can, including getting initial capital, which we were very fortunate to be able to do. But the macro environment makes it very challenging depending on the type of business you have, in terms of getting early investors, early adopters, early customers. And so I guess the only advice I would get is really on the capital raising side, is to try to get enough that you create enough of a runway for yourself, for the macro environment to come in line with what you can control. I mean, that's probably the best advice I can give, although this whole conversation has been about how challenging it is to get capital. So we're back in that boat again.
Jason.
Sure. So I'm in the healthcare space, and what I did this summer is to really shift towards organizations that we have a high degree of alignment. And so I do have some institutional support now. I have a bank, a foundation that focuses on healthcare, First University Endowment, and then I just last week got a major pharma company to commit to the firm. But it's taken time, and it doesn't happen overnight. It's not from the PPM or the any of your pitch deck materials. It takes time building that relationship and that trust. And so start early, and it'll catch. And so just got to hang in there. You need some staying power.
Thank you so much.
Great advice.
All right, Jenny, I think it's a wrap. We've got 1 minute. So I want to first thank the entire group. This is our last convening of the year. What we wanted to do was make sure that we went out with some very helpful content for the community. It's important that we make those connections where policy intersects with boots on the ground, like the work that Carolyn and Hello Alice is doing, and then making sure that our investor community, as you're growing your funds, as you are looking for funds yourself to invest in, IDiF, our intention is to help make that movement happen. So with that, we want to thank John for the president of Center of American Entrepreneurship for the work you're doing. Please help support that act and get to know him and the work that he's doing. Carolyn and your Hello Alice team, thank you for your tireless efforts. We will continue to stand beside you, especially in the wake of some of these challenges, and here to support any way we can.
Thank you all. Thanks for creating space for these conversations. They're really important. So appreciate it.
Indeed.
All right.
Happy holidays, everybody.
Happy holidays,
Happy
everyone.
holidays.
Bye, everyone.
Thank you.
Thank
Take
you.
care.
Take care.